Good afternoon, everybody. Thank you for joining us on this lovely Thursday afternoon. My name is Trevor Sumner. Happy to have you all. This is one of, I think, one of the more fun webinars because and one of the things that I get told a lot about is how e-commerce is eating the world or software is eating the world. And I think those of us in retail who spend a lot of time looking at the economics, looking at the demand, looking at the sales, e-commerce is growing rapidly and there's a lot of opportunity. But ultimately, I fundamentally think that the greatest opportunity in retail is the physical store. And so I'm a little cheeky here, but this presentation is about why e-commerce is overrated. And this is a defense of brick and mortar in a post-COVID world. So with that, I'm going to jump right in. Talk about our agenda. I want to talk about e-commerce's growth because that's really been why people are so excited about it. The rise of omni-channel and thinking through the multiple different channels and how they interact. Talk about profitability and retail metrics from a financial perspective. Talk to you about why I'm fundamentally excited about the upside in-store technology, and then leave it open for questions and answers. So with that, I will dig in. It starts with the great pandemic clickbait lie, right? Which is, e-commerce accelerated 8 years and 8 weeks. We heard this all over. I, saw it, just not even too long ago. And, they're still cutting off this graph, April 2020. And the reality is if you follow that graph along, it goes down after that, right? And if you look at what growth actually looked like, it grew from 600 billion to 795 billion. Now that's huge growth. That's a little over 30% growth, but it had been growing about 14%, right? So if you look at 32% year over year increase versus 14%, it's about a 2-year increase, not an 8-year increase. And in fact, if you actually kind of looked at the data in terms of retail store sales, they grew at about a 2-year pace as well. And if you look at it at e-commerce penetration, e-commerce jumped to about 21%, which was projected to happen at 2023. So no matter how you slice it, it's like 2, maybe 3 years, right? And that was probably true as of about 3 months ago, but the world changes pretty quickly, right? So but even again, the whole narrative around 2020 was wrong, right? Brick and mortar saw 4.2% growth in 2020. Right? What, CoreSite was predicting 20,000 stores closing, the true retail apocalypse, although we've been talking about this, retail apocalypse for so long. But even during a pandemic, brick and mortar sales saw 4.2% growth. And that's twice the normal average. So pretty impressive. Now, there's a lot underlying that, right? Restaurants closed, so we had to shift our spending to grocery. We'll talk a little bit about that. But this whole notion that brick and mortar is dying is just plain wrong. I mean, one of the things that I say to VCs who say, "Oh, well, the future is e-commerce and physical retail is dying." To me, what I respond to is, what would you say if I said to you, "Hey, I'm losing weight," and you said, "Well, how much are you losing, Trevor?" And I said, "Well, I'm gaining 2 pounds a year." You'd tell me I'm crazy, right? So physical retail is dying, but growing 2% a year. And, in the worst, pandemic that we've seen in a century, grew 4%. So it's just fundamentally untrue. And in fact, and this is new data, that brick and mortar is now growing faster on a percentage basis than e-commerce. Stop, process that. Brick and mortar is growing faster on a percentage basis than e-commerce. Now, and that's the first time that's happened, since 2008. Right? So that's pretty big news. Now, the reality is, one of the things I'd like to say is that statistics never lie, but the people who use them do. And so let me tell you all the lies in this little, kind of equation, right? So you're comparing Q2 2021 to Q2 2020. Now, we remember Q2 2020, huge drop, right? So, this is a little bit of an unfair comparison. And where possible, I always try and give context to statistics and how you think through things. It's kind of like, inflation's really bad year over year, but compared to 2019, and it's not nearly the 6.9% that you're reading in the news. Now it's still up and it's still a concern, but you've always got to kind of baseline this data. So when you look at this graph, right, you see the gray, which is brick and mortar, and the blue, which is e-commerce. One thing is pretty striking, right? You look at this growth path And you'd end up, kind of at that 1.4 trillion, something like that, just overall for retail combined. And we're well up above 1.6, nearly 1.7 trillion dollars. So a considerable increase in retail growth. And if you actually look at, it's more driven by this gray bar, which is brick and mortar, than this blue bar, which is e-commerce. And so, if you look again at the data, it's this gray bar compared to, say, Q1 2020, which is right before the pandemic, or even kind of Q4 of 2019. You're talking about 12% growth in 18 months. And when you put in Q4 spending up here, you're probably going to see something closer to 15 to 18. So that's pretty tremendous growth from the retail store side. So this notion that brick and mortar is dying is this myth. It's something that people say because it gets clicks. Every snowstorm in New York is now a snowpocalypse, even if it's 1 inch of snow, or it's a bombogenic cyclone, or polar vortex. It's a little cold and windy today. And so you talk about Amazon, right? Like Amazon has benefited so much from the pandemic. Well, maybe not. This is a new graph I got from Jason Goldberg at Publicis. If you look at project Amazon sales over time, right? What they projected in Q1 of 2020 was to be about where they are now in Q3 2021. So they got a lift, but even like Amazon sales are normalizing back to what they would be. So maybe this acceleration isn't even 2.5 years, maybe it's less than a year. And fundamentally what that means is our shopping behaviors appear to be much more ingrained than what we give credit. And I believe that fundamentally, that there's a reason that we do physical retail shopping, that it's a fundamental, we are physical beings, right? We have fundamental human needs to interact with things physically. If you've ever been in an Oculus and you put it on, super cool for about 5 minutes, and then it starts making you sick. And arguably a lot of things that we're learning about social media and Facebook is super good idea, but if you use it too much, it makes you sick. And that means spiritually, in terms of fulfillment, people crave physical retail experiences. And so we've seen these e-commerce jumps because out of simple necessity, now that the pandemic is being controlled by vaccines, by the new Pfizer pill, which is 89% effective in preventing hospitalizations, et cetera, we're going to see people go back to their natural behaviors. And that's going to be a mix of e-commerce, which I think of as a buying layer, and physical retail. And so this is some pretty surprising data that people aren't looking at. And if you actually look and try and do comparisons, like who are the big winners here? One big winner is big box retail. So you look at Walmart and Target, and you look at the number of store visits compared to 2019 pre-pandemic, right? Target, and I just bought Target stock just looking at this graph because I'm impressed by it, is up about 15%, right? A little lower on the September timeframe, but 16, 15.9, et cetera. Walmart is in that kind of 3.7 to 5.3% range, although had a lot less earlier in the year. And this is why I'm impressed with Target, that and their private label sales. And as I said, ended up buying the stock, right? So we're seeing a lot more traffic even to retail stores that are open. And grocery is a big one that has won here on the physical store side, right? And so, as we look at this, I'm trying to give you all the background as to different ways to look at the data. If you look at comparing, and again, this is from Jason Goldberg at Publicis, here's the 2019 spending. You can see as 2020 comes around, a huge bump as we realize, oh my God, no restaurants at all. And then it jumped down in April and May and has stabilized around here in 2020. But now you see it actually on a growth trajectory throughout 2021, even as we return to restaurants. So why is that? So, one is, as we get control of this pandemic, I would expect this to drop a little bit as we do return to restaurants more often. But also, I think one of the things that grocery retailers have done a really nice job, and so the big box retailers, is saying, okay, we've got this traffic now, how do we leverage it, right? And we leverage it by taking in-store traffic, converting to omnichannel retail and loyalty and CRM, getting first-party data and building relationships. But they also do it by investing in high-margin categories like beauty, baby, health, and pet. And so when we talk to grocery retailer chains and what they tell us is they're going to invest deeply in these categories to steal that spending from the Ultas and Sephoras to that beauty spending, to steal the pets spending from the Petcos and the PetSmarts, to basically try and create that one-stop shopping. Because if you're coming in every week for grocery, if you can, through convenience, provide access to the types of selection and experience you expect in those categories, it's extraordinarily powerful, and you can kind of increase spend. And so this has been a really impressive story. I do think that over time, more diners will return to restaurants, so you should see some reduction, but this is a huge increase in spend. You're talking about 15% over the course of 2 years. So another big winner. And then the other thing that I look at is, and this is a graph that was recently shared on my LinkedIn, which is, this is the percentage of dollars spent on goods, which is the blue line, and services, which is the red line. And as you can see, going back in 2012, they just kind of evened it out to 100 so that you can kind of baseline it, right? And so you look at it, and somewhere around 2014, these curves start diverging in pretty big ways, right? People start spending a lot more money on services than on goods. And this goes way, 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 way down, right? So if you actually look at it, coming back from, this gap right here completely inverts during COVID and brings us back here. So we immediately stop going out. We stop spending on hotels and services and massages and all those type of things, and spend that on goods instead. And so you see this big inversion. So if you look at the magnitude of the inversion, it's about 17%. It's pretty big, right? And I do think that over time, you're going to see that come back to parity, and long-term potentially invert, as we remember all those wonderful services that we love, like massages. So, I think we have we're at the specific moment in time where we have to think about, what is the long-term trend, and where are people going to spend their money in the future? And part of it is the fact that, millennials, Gen Z spend a lot more on experiences, hence the services revenue kind of being higher over time. And so one of the questions is, how can retailers not just capture new categories like beauty or pet or baby or health, but how can they capture spending like services? And you're seeing some interesting models here, whether it's CVS and Walmart investing in health and capturing some service revenue around health and medical. You're seeing Nordstrom Local offering a ton of services to complement the shopping experience. Neiman Marcus offering to sell your high-end handbags on the secondhand market. There's a variety of really interesting things to capture the service revenue now that you have that attention right now. And that's the key, really, is that brick and mortar, you capture a customer, a real physical customer in front of you, and how you monetize that customer over time is extraordinarily valuable, because online, a shopper is just a unique identifier, a cookie. In store, you can have a conversation. You can really monetize that interaction across not just your display, not across just your mobile phone and your data, but also physical interaction, sales associate interaction, during the checkout, during delivery into the parking lot. There's so many different ways that you can start thinking about all those interactions and thinking of holistic ways that you can expand your monetization. And that's a lot of what's kind of happened with omnichannel fulfillment. Now, if Steve Dennis was on this webinar, he would yell at me for talking about e-commerce versus brick and mortar like they're separate things. The reality is, it's about unified commerce, and all these channels actually really complement each other, which is part of the point of this webinar. And we're seeing a real rise of omnichannel fulfillment, and there's just a variety of different things that you can look at. So if you look at who actually won during COVID in terms of gaining in e-commerce, it wasn't Amazon, as you saw from that graph earlier. It was people like Best Buy and Target and Dick's and Ulta and others. Ulta saw a 200% increase in e-commerce, and 40% of e-commerce orders were being fulfilled by local stores. Target acquired Shipt and is now kind of leveraging that infrastructure to deliver for other businesses, but also for their businesses from an omni-channel buy online, pick up in store, or buy online and delivery, and leveraging the local store's fulfillment. And so the reality is brick and mortar retailers took e-commerce share from online only retailers like Amazon and D2Cs. And so really, really fascinating. And in fact, if you look at, kind of the stats about, where people are spending their money, and what's the role of the store, they're touching, tremendous amount, probably a little over 90% of all transactions. So 80% fulfilled in store. Of the remaining 20%, over 40% is being fulfilled by the store for the first time ever. And so literally 90% of transactions go through the store one way or the other. Now, there are lots of different services like BOPIS, curbside, and local delivery. And it's really interesting because the Wall Street looks at e-commerce as, kind of gives you better revenue multiple on it. So when it comes to a question I hear a lot is, what is buy online, pick up in store? Is that classified as e-commerce or in store? Now, if you look at financials, it's always e-commerce because, CEOs are looking to pump up that number. And again, if you break it down, in terms of BOPIS, local store fulfillment, et cetera, like a pure e-commerce model is only about 10%, right? And so, it's really fascinating to see like how US click and collect sales are kind of altering our view and these mergings of different channels and challenging us to think about how to classify this. And so we're seeing consistent growth. Obviously in 2020, we saw huge growth in buy online, pick up in store. It's a little less in 2021 and projected for 2022. And then we've got all the delivery surcharges, postal service issues, really challenging e-commerce economics. And so, as we look at the increases in shipping, trucking, delivery services, all these type of things, it's going to be more challenging for e-commerce, which has worse margins overall for most categories, right? If you're buying a Gucci bag, the cost of your shipping is de minimis compared to, the margins on groceries, as we'll see in a second. And so, interestingly, this is why Amazon has invested multi-billion dollars into their delivery infrastructure, right? It was such a big cost for them. And this is one of the things that Amazon does very well. Professor Scott Galloway points this out, that they look at their biggest cost centers and they start, kind of automating them and scaling them. E-commerce hosting, it's a big thing. So they launch Amazon Web Services. Delivery and of packages is one of their big line items on and cost centers. So they've kind of automated that. And now they deliver more packages than FedEx. 2/3 of Amazon packages are being delivered with their own fleet at this point. And most e-commerce vendors can't do that, right? And most e-commerce vendors are tied to this. And if you look at shipping costs and trucking and all those things, I mean, you're seeing costs at all-time highs right now due to a labor shortage, due to a variety of different factors. So, one of the reasons that people lean towards buy online, pick up and sale is because they want to avoid the fees associated with that very delivery, right? And those delivery costs seem to be going up rapidly, right? And you can look at this if you look at your Instacart bill, or like if you ever ordered food on Caviar, somehow a $40 order becomes a $60, thing with service charge, delivery charge, and it all adds up very quickly. And so if you ask the number one reason for shoppers about what they like most about buy online, pick up in store, it's not having to pay shipping fees, right? And then there's the wait time, and some of that stuff is going away with automated micro fulfillment. Walmart just opened up a huge micro fulfillment center in Texas. And so we'll see more and more micro fulfillment kind of eat away at that convenience side of the house. You've got avoiding the risk of package theft and, porch pirates, as they call them. And then there's the ability to like check the order, return it, all that type of thing, like have that physical experience. And interestingly, if you ask the retailers over on the right, why do they offer BOPIS? Number one is to attract shoppers who can make additional purchases in store. Because actually that's where the profitability is, right? So this notion of fees around e-commerce and not as profitable shoppers on the retail side of the house has kind of created BOPIS, but the foremost reason for BOPIS is to play into the hands of brick and mortar. And increasingly, as we see this as a greater and greater share of e-commerce, what this really means is e-commerce is going to be an engine for growth for in-store sales. And so this is a really fascinating dynamic. And you see, surveys about consumers using omni-channel services, and 80% care about like various different kind of curbside pickup and click and collect and all these different kind of services. They continue to want to use them on an ongoing basis. And so one of the things that I think is really important for people to think through is, how do you turn your in-store customers into omni-channel shoppers? And so this is an example we did with the CoverGirl. And we hang our hand on sales lift, and this drove 40% sales lift of all SKUs. But what's really interesting is 25% of people who walk into the store engage with Perch, and 20% of those gave their email or mobile number as part of the experience. So think about, what if you every single month could convert 5% of your store traffic to give your mobile number, email address, and that data, so that you can remarket to them and say, hey, here's some coupons, some loyalty to get them to buy stuff online, just some selection that may not be in store. This is how you start leveraging your store footprint in a holistic, unified commerce vision. And I think this is, we're going to see this more and more, and we're seeing interesting things. There's a company called PodDrop that does a sampling display where you just put in your phone number and your email address, and out pops a little sample. And the whole point is to use the store to collect first-party data. And so we're seeing that a lot with QR codes. I think that we're seeing a rise of QR codes in lots of different places. On one hand, like, we can look at all the statistics here, around QR code growth. The reality is, we talk about it being ubiquitous because everybody, including grandma, went to the restaurant and scanned a QR code, and now they know what they are. The reality is, I haven't seen a single good study of QR code usage at retail that is encouraging. And that's because people just slap a QR code on a wall, or slap a QR code on the back of a Heinz ketchup bottle, or maybe even on the little price tag on the shelf. And the reality is that doesn't drive engagement when there are QR codes everywhere and you don't know why you're scanning the QR code. And one of the things that we've seen is the incorporation of QR code in digital with a reason and messaging as to why to use it, to drive about 10x conversion rate than what you would traditionally see from QR codes. And so, thinking through these physical store experiences and how to convert into digital behavior, I think, is really critical. And then let's talk a little bit about retail economics. And I use this as an example. Grocery is one of the most strained in terms of margins. And so if you take a look about, whether e-commerce fulfillment is profitable, here's an example from grocery, right? So if you look at in-store, traditionally, grocery margins are in that 3 to 5%. Let's call this 4%, based upon the graph here. So that's profitable. I mean, you have to be really operationally efficient to get this type of margin on a scalable basis. There's not a lot of room for error. So if you're doing home delivery and the grocer has to pick from the store, you're losing 15% on every order. 15%. Now, this blue dot is if you charge a $7 delivery fee or a $4 click and collect fee. So even if you charge a $7 delivery fee, you're losing 8% if the grocer picks from the store. You're seeing, if grocer picks from a dark store, you're losing 10%. With the $7 delivery fee, you're losing about 4%. If you're picking from a warehouse, even with the $7 delivery fee, you're losing money on every order. You can only start making money is if a third party picks from the store and you're charging $7, and of course a third party is going to charge as well. So now you're talking about the consumer paying $10, $15 for delivery. It's a lot to ask of consumer for groceries, especially on a weekly basis. And you can look at centralized fulfillment, again, kind of the same kind of area. Only if it's a micro fulfillment center, which is why we're seeing a lot of this, plus you're charging a $7 delivery fee, can that ever really make money anywhere near close to grocery margins? So that's why click and collect, where buy online, pick up in store, that last mile delivery, you can see generates an additional about 10% margin here, comparing grocer picks from store for home delivery versus grocer picks from store, click and collect. And so this is where click and collect has really started to kind of gain a lot of traction with big box, with grocery stores, with the Costco's of the world, because ultimately for a lot of people, delivery just doesn't make any economic sense at all. And so again, even in an e-commerce model, stores are the key to profitability, right? So, here's a quote from Everlane CEO, Michael Preisman. What online only company is really profitable? Basically none of them. That's this dirty little secret, right, that we have. And you say, well, what about Amazon? Amazon doesn't make money on its direct e-commerce business. They make money on AWS. They make money on their marketplace, fulfilling for other people. And sure, there are a bunch of e-commerce businesses with high margin items and some other ones, like that. But fundamentally, the store is the key to profitability, because brick and mortar unlocks 7x the spending. So, if you look at e-commerce only shoppers versus omni-channel shoppers spend about 7 times as much. That's how much loyalty matters. That's how much cross-sell matters. That's how much average, items per basket get influenced by that brick and mortar experience. Product return rates, huge problem. 70% lower in store versus e-commerce, right? I just bought a bunch of stuff for Halloween. I needed a kind of white flowing robe thing. Don't ask. I bought 5 versions of it, returned 4. Just, and this is common behavior, and it eats away your margins. I mean, there's just, when you talk about returning 4 of the 5 items, there's no way anybody made money on that transaction. And then if you look at, surveys of brand impact, stores have about a 16 to 37% increase in the impact and connection between shoppers and their appearances or their thoughts around the brand and their emotional response to the brand. So fundamentally, and one of our investors, Mary Gay McKay, said, that the future of retail is digital, but the future of brand is physical, right? And so even with the digital store, the physical item is how brands are built. And so there's lots of different studies that you can see where physical shoppers spend 83% more and are key to unlocking higher spending online. So if you look at omni-channel customers, they spend more online, just on the online portion, than online only customers. So brick and mortar is key just for your online customers as well. And here's just the magnitude. Forget my returning 4 or 5 items for Halloween. It's a $550 billion problem. And if you look at the size of returns, and it's growing at a massive rate. That's why there are a ton of interesting businesses like Happy Returns and others focused on the return logistics problem, because it costs so much that if you don't solve this problem in significant ways, virtual try-on so that you can actually take a look at the beauty products on your face, or hair color, etc. True Fit and others who make sure that you're buying the right size. Walmart bought a company called Zekit, which scans your body and then makes recommendations on sizing. Although honestly, I think they're going to use that more for advertising than anything else. So just huge. If you look at the return rates per categories, like online purchase is about 30%, right? You look at auto parts, 21, housewares, 12.3. Like compared to brick and mortar, that's 3x, 5x, 7x. It's a real problem. And so additionally, we talked about how brick and mortar, kind of increases your e-commerce. Retail locations, if you open up a retail location, studies show that it drives about a 37% increase in your e-commerce in that region, in that neighborhood. So, even the retail side of the house there's a ton of revenue being generated from that retail store, but it's being attributed to online and e-commerce. So lastly, as we start talking about economics, you take a look at the online cost of acquisition, right? So, if you talk to any D2C company who's, kind of grown up online, they'll tell you this: the cost of acquisition is just rising at a phenomenal rate. And this is the problem with monopolies, right? Which is there's just not enough competition. And so Facebook is trying to figure out what's the max amount of money that they can siphon off by different category, and people still spend money on them. So as long as you're just barely profitable, Facebook's going to take the rest, right? And they keep on just, more and more and more and more. They're squeezing all the margins out of the business. And so, we're seeing typically, 50% increases in the cost of acquisition, 300% increases in CPCs. And ultimately, in-store media is starting, now that we're starting to do measurement, it can be more cost effective than online. And so this is, a snapshot of one of our clients at Perch. And you can see that their CPAs, or cost per acquisition of a customer, are about 32 cents. And their cost per click, cost per interaction, is 14 cents. Now, if you look, it depends on your category, of course, but overall retail CPCs are around 81 cents. And so this is about 75% cheaper, right? And, I would argue that, if you look at the marketing funnel, you want to influence that the most valuable media influences at the bottom of the funnel. It increases conversion. And what's more, effective in terms of bottom of the funnel than somebody has the product in their hand, they're 20 feet from the point of sale, and now you have media to influence their shopper behavior. That's, that's the most valuable type of media that you can have. And yet you're getting it at a cost per click that's 75% less than Facebook. Now, fundamentally, the challenge for in-store media has been the lack of attribution and the lack of measurement. And so we're starting to see these problems be solved. So Kroger, for example, has this amazing group called 8451, where they're doing in-store analytics and really advanced data analysis so that you can see like what your sales lifts are. And now, at the same time, I still think for a lot of we're seeing digital signage networks come up. We've seen cooler screens raise, I think, $70, $80 million. CVS with their health hubs looking at, deploying digital signage at scale. We're seeing a lot of people deploying these kind of large scale digital signage networks. But the challenge is that they're selling them to brands on a CPM basis, or cost per thousand impressions. And nobody online has bought CPM based ads in a decade. People want cost per click, cost per interaction. How many verified, engaged shoppers actually were influenced by this media? So fundamentally, I think the important next step is to look at the spend and compare it to interactions in store. I want to know how many people, I want demographic segmentation, and I want to know how many people touched my product or picked up my product. How did I influence that shopper journey? And ultimately, what was the sales lift, right? And so, that's one of the reasons, that we're finding that, this kind of measurement of this, solving the measurement problem and solving, with retail analytics, increasingly the store is becoming more valuable. And what we're seeing is 66% of direct-to-consumer brands who have raised more than $6 million have opened stores. Because the other interesting thing is that as you scale, the cost of acquisition online goes up and up and up, because you no longer have the low-hanging fruit of demographics. Like if you're Warby Parker, for example, you immediately go for anybody who says they have eyeglasses in their profile, right? And potentially even look at their profile pictures. It's like, great, we got the easy people, right? But then there's the next people who we can't readily identify as like, hardcore eyeglass wearing people. And so we got to go after people with context. We have to go with people who it's not as clear, the affinity is not as great. And then, of course, Warby Parker launches, and then as you start getting scale, all of a sudden, all the existing eyeglass wear people say, whoa, we're going to try and compete. And so they start bidding up, the advertising as well. And so as you get increased competition, as you get scale and have to compete for less of the hanging fruit audience, your cost of acquisition goes up and up and up. But the cost of acquisition for opening up a store, you just open a store in a new geography. I mean, America is a very big place, and the world is even bigger. And so, you can open tens, hundreds of stores, thousands of stores, and still not get the types of exponential growth and customer acquisition costs that you see online, because you just run out of inventory, you run out of customers, right? And so ultimately, stores are how you drive your cost of acquisition down. And you see this, interestingly, if you look at Warby Parker's IPO, and Allbirds IPO, I think it's really interesting to look at how Warby Parker includes the cost of stores in their cost of acquisition. Interestingly, Allbirds does not, and I think that's a little bit of funny business in terms of the way they, report financials. And so, you look at Warby Parker, and until 2020 and the pandemic, Warby Parker sold 2/3 of their sales in store. So it was 2/3, 1/3. During the pandemic, that flipped to 60-40 online, and now it's at 50-50 and returning back. So Warby Parker, who everybody thinks this is an e-commerce glass company, actually is fundamentally, at least majority, is a brick and mortar eyeglass company. And so these are all the reasons that stores are powerful in terms of acquisition. And if you look at where people are looking to increase their spend on money as of this year, here's a nice little survey. And you can see social media and internet brand advertising are number 1 and number 2, but shopper marketing is number 3, right? Ahead of mobile marketing, owned media, paid search, TV, print, all these other things. But more interestingly, and I thought this was super interesting, if you look at this purple bar, that is the amount that people are increasing their ad budget by 5% or greater. And if you look at it that way, shopper marketing is the number 1 category ahead of social media and internet brand advertising for significant increases in marketing budget. And so why is that? Because it works. Because right now, I find that retail stores are a huge opportunity because they haven't changed so much in the past couple decades, although we're starting to see real change over the last 2-3 years as people make very big infrastructure changes. You look at what Bed Bath & Beyond is doing around redesigning their stores. So many retailers have just said, okay, it's time to redesign our stores with power in mind, with analytics in mind. Walgreens launching 5G at 9,000 stores. I mean, with connectivity in mind, digital in mind. Like, we're starting to really kind of see the foundational layers where we can marry shopper marketing techniques that are traditional merchandising, marketing optimization with the digital engagement and the digital data collection. And so it's a fascinating time. And I think shopper marketing is going to be a huge area of expansion in the coming days. And, if you look at it, stores have continued to expand. I think much more than people talked about in that retail apocalypse hooey, that myth. If you looked at it pre-COVID, 87% of store closures were department stores or specialty apparel, right? So, that whole story about the store closures was really about a hollowing up of the middle class, a department store, industry and category that had failed to find its value proposition, and was giving way to special category stores in beauty like Ulta and Sephora, and was actually giving away a lot of shoppers to big box and discount. In fact, just pre-COVID, 16 retailers in 2019 responsible for 73% of store closings. So those numbers were really driven by some very big failures of large scale stores that had overexpanded, that had taken on private equity and leveraged the debt up, and they went bankrupt because they didn't have a good value proposition. So what happened in 2021, right? We're now still in the pandemic, and we have 2 times as many store openings than closings in 2021. So you can see there are about 5,800 store openings, and about half that in terms of store closings. So if you actually kind of dig in there about what's happening, the store openings is very much led by discount, right? So you look at Dollar General is opening 1,000 of those new stores, right? So that's almost 20% of this. Dollar Tree, 600 stores. Five Below, 175 stores. TJ Maxx, 120 stores. So you kind of see this: Burlington, City Trends, Ross, Costco, even Target, which is more big box, but has a little bit more of a kind of affordable, kind of price point, and where value is part of their proposition, is expanding. And if you look at who leads the closures, it's really specialty apparel, and continues to be so. So there are a variety of different specialty apparels, even Foot Locker, American Eagle, Christopher, Banks, et cetera. And so this is really a story about categories, about value propositions, and not about physical retail. And in fact, physical retail is bouncing back and expanding. It is growing faster on a percentage basis than e-commerce. Store openings are doubling store closings. So, and there's a reason for it. Customers want it. We talk about how product discovery is the core of a value proposition of a store, that people want to touch products and feel products and look at them. And the reality is that looking at a screen at a results page of a search on Amazon or anywhere else, doesn't actually give a good product discovery experience, right? So, interestingly enough, people talk about millennials and Gen Z. 82% of millennials and 67% of Gen Z actually prefer shopping in store, right? And so Doug Stevens talks about how the primary role of the store will not be to sell product, but rather deliver like an emotionally galvanizing experience, and use that to really connect people and products in a way that builds brand. And ultimately, whether they shop that day in store, or they leave and they buy it eventually. It's really about trying to figure out, how do we measure brand equity and even measure the attribution so that you can see location specific revenue recognition. And, if you look at shopper engagement trends, on a post-COVID basis, 67% of shoppers agree that stores will build back better by designing engaging and sustainable experiences. We're seeing that with Target opening up Apple stores and Ulta, having, kind of Ulta shops within their stores. They're quickly kind of both having the value play, but also building on experiences. Bed Bath & Beyond's doing an amazing job. I'm really bullish about what they're doing around their store remodeling. And, we're really talking about kind of, again, connecting people and products, because that's fundamentally what shopping does. And what's interesting to me is that when we think about what we want in connections products, we really rely stores just really primarily on packaging and pricing and a little bit of promotions. But most of the digital content that we look at, that we care about, videos, reviews, branding, influencers, explanations, how-tos, none of that really makes it in store on a product level basis. And so fundamentally for us, I think, that's the ultimate thing to solve, because the consumer sentiment towards brick and mortar post-lockdown is still high. The missed features of shops are social interaction. You can't replicate that online. It's having a day, morning, afternoon out to leaving the house. And who can't relate to that in a COVID world with all of us working from home? Like, I love more reasons to get out of the house. And I'm happy I have a puppy who needs to be, walked 3 to 5 times a day. The ability to see and feel products. There's some interesting things trying to replicate that online, but you're never going to be able to replicate that. And this is, the majority of shoppers want these things. And so the brick and mortar shop has this fundamental role to play. And ultimately, that's why you see Walmart, Target, Bed Bath & Beyond looking at how to take more share from the department stores that are failing, to take some of that experience and bring that into their doors. If you're Kohl's, it's launching Sephora at Kohl's. It's providing services like returns from Amazon and using that to drive. If you're CVS, they launched Glam Squad in store. I mean, CVS, right? If you think about what that retail experience is, and to have actually makeup artists in there, you're really seeing them trying to elevate that experience. And we're going to continue to see this as people try and capture, Target launching a $1 billion activewear line. They just launched a new pet brand private label called Kindful. That's going to be a $1 billion brand by Q1, and they just launched it. I mean, they're really thinking about how to if you talk to what Target people are doing is they're reconfiguring the pet section to promote their private label brands and build better experiences overall. And a lot of that's going to be powered on data. And so that's what I'm most excited about when you think about, to me, the store has always been this black box where it's like, oh, we know it helps customers, but we don't know how much. We know it influences online, and we know 37% increase of online when I open up a store, but I can't really measure that on an ongoing basis. And if I change something in store, I don't really see it online, or I don't know how to attribute it. And so when you look at stores, it's fundamentally this digital desert of data where, you might have the number of people going in, store traffic, and you might have sales going out, but everything about how people browse products, where they go in store, which products they pick up, which ones they consider, which ones they add to cart, and which ones they ultimately sell, that data is not there. And that's where we at Perch are trying to fill in. And we're doing some interesting things. Here's some new metrics that almost nobody's measuring other than Perch clients, because they just don't have the data, right? So we use computer vision to detect which products you touch, and then respond with digital media. So here, the shopper is picking up Neosporin, or an antibacterial cream, and then we're promoting Band-Aids and other cut medicines, et cetera. But the fundamental idea is that we're actually instrumenting what people click on at the shelf. That's the way I think about it. Online, you click on a product, in store, you pick it up, right? So we are instrumenting the clicks at retail. So now I can look at, people talk about planogram design. Well, what do they actually pick up? How does the planogram design change the way that they pick up? And we're going to show you some surprising insights from that. For every product on the shelf, what is your pickup to sales conversion? you ask your e-commerce, counterparts, and they know exactly what the conversion rates are for every product. But talk about it in store and say, here are 10 products. What are your top 10? When somebody picks it up, what percentage of the time do they convert to a sale? Nobody knows because they're not measuring that stuff. And you can start looking at revenue per pickup and conversion rate and profit per pickup. You can look at pickup to screen conversion and which content engages shoppers versus not. But you have to baseline that by clicks and clicks that happen in the store. And so here are a couple examples. This is something that we launched with Purina. As you can see, you pick up the Puppy Chow Healthy Start Nutrition. It comes on. It tells you about some of the other things for your puppy. It does a nice cross sell. You can kind of click on it, get ratings and reviews. It even has like this kind of 28-day challenge with an AR mobile, scan a QR code, and you can actually do some fun stuff with your pet and, looking for the signs of a healthy pet. But the real interesting thing is the data behind this, right? So you're seeing every time that shopper picks up a product, boom, we know what they picked up, we know where they touched, and now we can provide the right content. But let's look at the data, right? So one of the things that people talk about is NCAP and planogram design. And if you ask them, what's the most valuable real estate on an NCAP? And every 99.999% of my conversations, they say the same thing, eye level. Eye level is buy level. It's all about being, right at eye level to convert. And it turns out that despite decades and decades of that being, the accepted truth, it's just not true. So we actually use sensors to determine where people touch. And I don't have the exact percentages for each of these because I've hidden them because it's Purina's data. But what I can do is on a heat map side of the house tell you that the reality is the edges were more valuable than being eye level, right? So you would actually rather be in the middle on the edge than center at eye level. And obviously, because edges are good and overall the top shelf is better, it drives about a 27% increase. The edges drove 35 to 52% increase. And so the best place to be is actually, eye level on the edge, right? And next time you go to a grocery store, you'll actually detect this. And so just as you go down the shop, look at that end cap approaching you, and you can see the products on the edge, but then as your eye drifts into the middle over here, they all kind of blur together. And so it's kind of the way we just process visual information, I think, as humans. But this is data that overturns decades of how we think about planograms. And this is, I think, going to happen across the store, right? And because we can look at what people are picking up, if there's a sudden drop off, we know something's wrong, right? We've been detecting out of stocks, and cat products versus pet products, depending on what's going on and where engagement happens. We can also use this to do on an ongoing basis to determine optimal planogram design based upon not just pickup distribution, but also revenue distribution. So let me give you an example. Here's that same over-the-counter drug where you pick up an antibacterial cream and we'll cross-sell you Band-Aid, or you pick up a Zyrtec, we'll sell you Benadryl, for example. And so we can actually look at the sales data and say, well, can we use content to shift and change the way people interact? So for example, we had a hypothesis that we could get people to go from this 30-count Zyrtec to the 70-count Zyrtec. And that's exactly what we did. We saw a 50% drop and an 80% increase in 70-count by using digital to message somebody at the right point. And so not only can we detect what people click on at the shelf, we can use content to change the way they click on the shelf and point them to the products that matter. And those products that matter, typically you want to point them to your highest margin items and your highest converting items. And outside of the content influence side of the house, if you had to pick where to put your highest margin, highest converting product, where would you put it? Well, eye level is good and edges are even better, as we just established. So where if this is Johnson & Johnson, where was their highest margin, highest converting product? In the worst place possible. Bottom row in the center of the Neutrogena towelettes. And so we said, move that up. That's how you can start optimizing planogram design to drive sales. We can look at, we did a fragrance implementation, and we could show what is the value of a more ornate bottle versus a less ornate bottle. Actually, the packaging of an ornate bottle increases pickup to sales conversion by 20%. and increases content engagement from pickup to screen by 22%. And so you start thinking about retail and the future of retail and the ways that retailers can sell this data to brands, provide a platform. Think about like, Beta and Showfields and what they do to help emerging brands put stuff in front of shoppers and measure the effect. Shouldn't Target do this? Shouldn't Walmart do this? CVS do this? Yeah, Neiman Marcus, Macy's, all of them should do this, right? And so this is a new model to me where you can create premium space for emerging brands, existing brands, category captains, and say, here's how you perform. Your packaging is X% better or worse. Your content is X% better or worse. Your engagement is X% better or worse than the category overall. And here are the insights we can provide about how to better engage shoppers. That is hugely valuable to brands. And to me, this is really what the genesis of a Perch Shopper Marketing Cloud is all about. And we have a webinar that you can go online to our website to go listen to find out more about it and some of the things that we're doing. But ultimately, where I'm leading with all of this is that the future isn't brick and mortar or e-commerce. It's really about marrying the best of digital and physical shopping. And ultimately, it is completely inverse that 99% of digital media is spent everywhere but in store. So only 1% of digital media is spent where 85% of transactions occur. And we are going to see that invert. And ultimately, to do that, we need to be able to look at how people click on products in store and how to provide the right message at the right time. And what we have seen is that by taking this type of approach of marrying digital to each physical product through that measurement of a click, whether it be high end and luxury, where you pick up a fragrance and it animates into flowers and what you might smell in the bottle, whether it's more informational, where you can take quizzes, find the right fragrance for you, get directed to the floral area or the fresh area, get the information, scan the QR code, start measuring that shopper. Whether it's in accessories, where you might pick up a handbag and you want to configure it, and some of the items are not in store, but they're online, and you want to do endless aisle and configure that bag to be personalized just to you. And I'm going to email it to me so I can check out online. And whether that's bringing this digital not just to high margin items, but to mass market CPG and retail, to beauty end caps on Loge, we're going to see digital everywhere and see that drive 30 to 80, 30 to 100% sales lift. We're going to see digital being used to augment sales associates. And we're seeing some cool companies do that. Salesfloor, and Tulip are providing tools on iPads. Theatro has like a little mic in an ear that salespeople can immediately ask questions about specific SKUs or get customer service and help. There's a company called Rilla Voice that actually records all sales associates' experiences and says, you're asking not enough questions, too many questions, you're pitching this way or other way. And so all this technology and digital is being used to augment the brick and mortar experience. So, is e-commerce overrated? Well, I think about e-commerce and brick and mortar as channels that complement each other, but also that have specific advantage. If you look at size of market, physical retail is bigger. Cost of acquisition, physical retail is better. Customer spend more in store. Profitability, physical retail excels. Brand impact, physical retail is key. Where e-commerce has done an amazing job and has key value is around customer convenience. So if I know I want to buy something, I go immediately onto my phone, I order it, and then data and marketing, right? Oops, sorry about that. So, and data and marketing. And increasingly when it comes to customer convenience, we're implementing buy online, pick up in store. We're implementing various different things to leverage the store for delivery. And data is really the kind of open next frontier for people when it comes to brick and mortar. So for me, when I look at it, like retail technology is going to breathe new life at brick and mortar, right? So we've got all this amazing technology we talk about, but a majority of shoppers said they haven't even encountered the most basic in-store technologies, right? Digital signage, Perch. I mean, I'd love to tell you that Perch was in 30% of stores. Yeah, it's not. I mean, we barely, we don't crack us 1% of stores, right? and 35% reported zero exposure to any of these technologies. And so the future to me is thinking about how this technology can transform retail. That the biggest opportunity, like I think there's tons of stuff around e-commerce. You can eke out better conversion rates through multivariate testing, localization, personalization, sure. That'll be nice. I don't think it's going to change the game. I think social shopping has an opportunity to have a really big impact. But when I think about where brick and mortar is now, where there's very little data, there's very little digital, there are very little tools that are scalable and technology driven. And when you start implementing technology into those environments, the upside to me for brick and mortar is so much higher. And so again, that blurs the lines more. So, Steve Dennis is in my ear saying that separating channels is increasingly misguided, but we're going to start merging these worlds together. And ultimately, we're going to be spending a lot of time in brick and mortar stores. And I think brick and mortar will continue to be the key to unlocking profitability, to driving brand engagement and loyalty. And we're just at the beginning here with retail technology investments. So, investment in store, shopper marketing, fastest growing category of spend for increases of budget of 5% or more. I think it's going to be an exciting time. So I hope you enjoyed this. We're coming up on 3 o'clock. If you have any questions that you would like to ask, please feel free to do so in the chat and Q&A section of the Zoom and of the webinar. And thank you very much. If you want to reach out to us at any time, just reach us, go to our website at perchinteractive.com. You can follow us on Twitter at Perch Experience or email us at info@perchinteractive.com. And I will answer any questions in the remaining time. All right, so the first question is, do I see brick and mortar retail seeing a decline based upon that inversion of the service and goods spending? I think there are a lot of different pressures right now on the consumer. Inflation is obviously a big story. I think it's both being overblown, but also is considerably worrisome to retailers. The data that I've looked at show that although we like to blame it on the supply chain, a lot of the inflation is actually demand-based. I posted something on Twitter, just a couple of days ago with a really in-depth analysis about how much of it is from stimulus, pouring trillions in the economy, quantitative easing, throwing a lot of money into the economy and heating it up. And also that we have more savings. So there's a lot of spend driven here. And I think that people are going to look to spend money. So I think there will be a switch to service, but I think spending will be significant. I think the question is, will wage growth and kind of long-term inflationary pressures kind of erode the margins of retail in terms of profitability perspective? But from a sales perspective, I expect it to continue considerably. Next question: where do I think is the next great growth opportunity in store in terms of technology? I think I've mentioned a couple of them. Right now, everybody's focused, very rightfully so, on supply chain. There's too many out of stocks. People are doing holiday spending and like starting that process right now, and they're terrified that they're going to run out of product. And so they're spending a lot of money to predict demand. They're spending a lot of money to make sure that their product's on the shelves, to optimize their supply chain, a lot of logistics, even on delivery. I think some of that delivery optimization is misguided. I think ultimately, it's going to erode a lot of the margins by shifting a lot of the spend towards delivery. And I think, as it's kind of like Uber prices. I don't know if you noticed, but Uber prices are up about 40%, 40. And so in New York City, it used to be like Uber was offering a price at the same amount or even less than a taxi cab and put them out of business, right? And now the prices are up 40%. And there are all these stories about people taking an Uber to JFK and it costing more than their flight, right? And, I think right now there's a lot of investment into things like, 15-minute delivery and other things that seem really, really exciting. But for the near term, just can't be profitable. And so I think the things that excite me, obviously, are the in-store things. It's computer vision, it's data, it's understanding what really happens. It's kind of like the planogram. I think when we shine a light to what actually happens in store, when we can start running experiments on A/B testing of planograms, A/B testing of content, A/B testing of promotions, dynamic promotions, AI-driven things. Like, we're going to start learning so much that we're fundamentally going to decide that we don't really even understand the shopper. And that's hard for us as an industry to accept. We've treated, in-store design and shopper marketing design as more art than science. And typically when you look at industries that do that, when the science comes along, they're like, no, you don't understand the nuance. But eventually the science provides a lot of data that inform that a lot of our artistic decisions aren't based on reality. And I think that's going to really fundamentally change a lot of things. And to me, that's the great frontier. That's the great opportunity, is to really understand retail at a more granular level, at a more accurate level, and then use that data to reimagine the world and to reimagine where we invest. Like, I would tell you to invest less on online ads and more on in-store experiences and digital, because I know it's more impactful. I see it. I mean, it's 5 times more impactful. The return on ad sales is just much higher. And we're going to start seeing that. And I think the data is going to be inevitable. And so that's exciting to me. So, all right, we're at 3 o'clock. Thank you, everybody, for your time today. I hope you enjoyed this. We're going to put the recording online, and we'll follow up with the slides as well. But thank you so much, and have a great day. Take care. Bye.